Imagine a world where your money isn't controlled by a single bank or government. A world where you could send value to anyone, anywhere, at any time, without a middleman taking a cut. A world where the very concept of money is being rewritten, not by politicians or bankers, but by a decentralized network of code and cryptography. It sounds like science fiction, but it's not. It's happening right now, and it's known as the cryptocurrency revolution. For centuries, our financial lives have been tied to a piece of paper or a number on a screen, all of it backed by the authority of a central bank. We've been told this is the only way money can work. But what if there's a better way? What if the digital age has given us the tools to build a financial system that is more open, more transparent, and more fair? Beyond the Dollar is your guide to this new frontier. Forget the headlines about volatile prices and overnight millionaires for a moment. This book isn't about getting rich quick, it's about understanding a fundamental shift in technology, economics, and power. We'll explore the groundbreaking technology of blockchain, uncover the story of Bitcoin's rebellious birth, and demystify the smart contracts that are building a new kind of internet. Whether you're a curious skeptic, a budding investor, or just someone who wants to understand why the financial world is in a state of flux, this book will be your compass. We'll go beyond the hype and dive into the core ideas that are challenging the very definition of money. Prepare to have your assumptions challenged and your mind open to a world where money is no longer a tool of control, but an instrument of freedom and innovation. The revolution is here. Are you ready to understand it?
Welcome back to Ecolib. Before we begin our journey into Beyond the Dollar, if you're enjoying this audiobook, please take a moment to hit the like button and subscribe to the channel. It really helps others discover this content and join the conversation. Now, let's begin with Part 1, The Foundations of a New Economy.
Chapter 1, The Anatomy of a Digital Currency. To truly understand cryptocurrency, we first have to deconstruct it. The word itself is a portmanteau of cryptography and currency, and those two concepts are the very foundation upon which this new financial world is built. At its simplest, a cryptocurrency is a digital form of money created and secured using advanced encryption. Unlike the money in your bank account, it doesn't need a central bank or a government to control it, issue it, or verify its transactions. Instead, it relies on a decentralized, peer-to-peer system. This distinction is crucial. Traditional money is a debt-based system where you trust a bank to manage your funds, while cryptocurrency is a trustless, rule-based system where the code, not a third party, enforces the rules. Think of it this way: when you send money through a traditional bank, the bank acts as a trusted middleman. It keeps a central ledger, or record, of everyone's balance and verifies every transaction. This centralized model creates a single point of failure. If the bank's servers go down or if it is compromised, the entire system is at risk. With cryptocurrency, there is no single middleman. The ledger is distributed and shared across a network of thousands of computers, and every transaction is verified and secured by the participants in that network itself. The peer-to-peer nature means that you can send money directly to another person, anywhere in the world, without needing permission from a bank, a government, or any other institution. The magic of the blockchain. This distributed ledger is what we call a blockchain. It's the engine that powers every cryptocurrency, and it's arguably the most important invention to come out of this revolution. A blockchain is a chain of blocks, and each block contains a list of transactions. When a new block of transactions is created and verified by the network, it is cryptographically linked to the previous block. This creates a permanent, chronological chain of data. Because each block contains a unique digital fingerprint of the one before it, it's nearly impossible to go back and alter a transaction without breaking the entire chain. If a hacker wanted to change a transaction, they would have to simultaneously change that block and every single block that came after it across the entire network, a task so computationally difficult it is considered practically impossible. This immutability is what gives blockchain its power and trustworthiness. To be more specific, each block includes a list of recent transactions, a timestamp, and a unique cryptographic code called a hash. This hash is like a digital fingerprint for the block. Crucially, the new block's hash is created using the data from the new transactions and the hash of the previous block. This is the chain part of the blockchain. If you tried to change a single transaction in an old block, that block's hash would change. That would instantly invalidate the next block, and the next, and every block after it, because their hashes are all linked together. This structural integrity means that the ledger's history is self-validating and cannot be rewritten. In plain English, imagine a digital notebook that is copied and shared with thousands of people around the world. Every time a new page of transactions is added, it is linked to the page before it with a special digital lock. Because everyone has a copy, and all the pages are locked together, it's impossible for one person to secretly go back and change an old page without everyone else noticing. This makes the notebook a completely trustworthy and permanent record. Key concepts demystified. As we move forward, a few key terms will pop up again and again. Let's get a clear understanding of them now. Decentralization. This is the core philosophy of crypto. It means that no single entity, no company, government, or individual, has control over the network. The power is distributed among all the participants, making the system more resilient to censorship, manipulation, and single points of failure. In a centralized system, a single government could shut down a bank, or a company could censor a transaction. In a decentralized network, the system would remain operational as long as a single node, or computer, is running anywhere in the world. In plain English, imagine a global spreadsheet where everyone has a copy, and all changes have to be agreed upon by a majority. Instead of one person, a bank, controlling the spreadsheet, everyone helps manage it. This makes it impossible for any single person to cheat or shut it down. Cryptography. This is the science of secure communication. In cryptocurrency, it's used to secure transactions, verify their authenticity, and protect your identity. Specifically, a hashing algorithm is used to create the unique digital fingerprints for each block. A hash function takes any input, a word, a document, or an entire block of transactions, and produces a fixed-length, seemingly random string of letters and numbers. A small change to the input, even a single comma, will produce a completely different output hash. This one-way, irreversible function is the mathematical basis for the blockchain's security. In plain English, cryptography is like a magical digital lock and key. It turns your information, like a transaction, into a secret code that is extremely difficult for anyone else to read. The hashing algorithm is a one-way machine that creates a unique fingerprint for your data. It's easy for anyone to check the fingerprint, but impossible for them to use the fingerprint to figure out the original data. Proof of work versus proof of stake. These are two common consensus mechanisms, which are the methods a blockchain uses to agree on the state of the ledger. They are the rules of the game for adding new blocks. Proof of work, POW. This is the original mechanism, used by Bitcoin. It involves miners, who use powerful computers to compete to solve a complex mathematical puzzle. The first miner to solve the puzzle gets to add the next block of transactions to the blockchain and is rewarded with new coins. This process requires a huge amount of computational power and energy, which is a common point of criticism. However, this massive energy consumption is also the source of its security, as it would be economically and physically unfeasible for a malicious actor to overpower the network. In plain English, think of proof of work like a massive, global race. Thousands of powerful computers, the miners, are all racing to solve a difficult math problem. The computer that wins the race gets the right to add the next block of transactions to the blockchain and earns a reward. The sheer work or effort they put in proves they are honest and prevents cheating. Proof of stake, POS. This is a newer, more energy-efficient alternative used by Ethereum and many other cryptocurrencies. Instead of competing to solve a puzzle, validators are chosen to create new blocks based on how many coins they have staked or locked up as collateral. The more coins you stake, the higher your chance of being chosen. The security of the network is maintained because validators have a financial incentive to act honestly. If they try to cheat, their staked coins can be seized. This method consumes far less energy and allows for faster transactions. In plain English, in this model, you don't race to solve a puzzle. Instead, you put up some of your own cryptocurrency as a security deposit, your stake. The network then randomly chooses a person to add the next block, and your chance of being chosen is based on how much you've staked. Since you risk losing your deposit if you cheat, you have a strong incentive to play by the rules. Wallets and keys. While we talk about owning crypto, you don't actually hold digital coins in a physical sense. What you own are a pair of cryptographic keys, a public key and a private key. Your public key is like your bank account number. You can share it freely with others so they can send you cryptocurrency. It is a one-way street, meaning you can't reverse engineer your private key from it. Your private key is like the password to your account. It's a secret string of characters that gives you exclusive control over your funds. If you lose your private key, you lose access to your crypto forever. This is why keeping your private key secure is the single most important rule in cryptocurrency. A crypto wallet is simply the software or hardware that stores and manages your public and private keys for you. It's also important to understand the concept of a seed phrase, which is a list of 12 or 24 words that acts as a human-readable backup of your private key. It's your ultimate recovery tool and must be kept safe offline. Wallets can be hot, connected to the internet, like a mobile app. Or cold, offline, like a hardware wallet, each offering different levels of security and convenience. In plain English, your crypto wallet isn't a physical wallet with coins in it. It's more like a keychain that holds two special keys. The public key is the address you give to people so they can send you money. The private key is the secret key you use to unlock that money and send it to someone else. The seed phrase is a secret list of words that can create a new pair of keys if you ever lose your original ones. It is your most valuable asset. By grasping these foundational concepts, you are already well on your way to understanding the mechanics behind this powerful technology. In the next chapter, we'll dive into the dramatic story of how it all began with a mysterious figure and a groundbreaking white paper. Chapter 2: The Original Digital Gold, Bitcoin. The Birth of a Revolution. The year is 2008, a time of widespread financial chaos. The traditional banking system, once a symbol of stability, was showing its cracks, leading to a global crisis of trust. In the middle of this turmoil, a mysterious figure known only as Satoshi Nakamoto stepped forward. Satoshi, whose true identity remains one of the world's great secrets, published a 9-page white paper that offered a radical new vision for money. Titled Bitcoin, a peer-to-peer electronic cash system, this wasn't just a technical paper, it was a blueprint for a new financial order. It proposed a form of digital money that could exist and operate entirely without a central authority, no banks, no governments, no financial institutions. This was a direct and elegant response to the lack of trust that had been so dramatically exposed in the old system. Satoshi's genius lay in a specific application of the blockchain technology we explored in the previous chapter. He used this public digital ledger to solve a long-standing challenge in computer science known as the double spending problem, which is the risk that a digital currency could be used more than once. Bitcoin's blockchain, a transparent and chronological chain of ownership, prevents this. Every transaction is a block linked cryptographically to the one before it. Once a transaction is confirmed and added to this chain, it's virtually impossible to alter, creating a permanent and immutable history of who owns what. This structural integrity is what ensures the system's trustworthiness without a third-party intermediary. The engine of the network, Bitcoin mining. The decentralized network is secured by a process called Bitcoin mining. As you know from Chapter 1, this relies on a proof-of-work consensus mechanism. Miners, who are essentially powerful computers running the Bitcoin software, compete fiercely to solve a specific cryptographic puzzle. It's more than a race, it's a constant, global competition that drives the security of the entire network. The first miner to solve the puzzle wins the right to add the next block of transactions to the blockchain. As a reward for their work, they receive a set amount of new bitcoins, known as the block reward, along with any transaction fees from the block. This process is crucial because it not only verifies and secures all new transactions, but it also introduces new bitcoins into circulation in a predictable, controlled way. The cryptographic puzzle itself is designed to be difficult, requiring immense computational effort to find the right nonce, a number used only once, that, when hashed with the block's data, meets the network's required criteria. The entire network automatically adjusts the difficulty of this puzzle approximately every 2 weeks to ensure a new block is found on average every 10 minutes, regardless of how many miners are competing. This ingenious feedback loop maintains a steady and predictable pace for Bitcoin's issuance, making the network security robust and resistant to a single entity gaining control. Scarcity and the halving, a foundational economic principle. One of the most important and unique concepts about Bitcoin is its built-in scarcity, a principle that sets it apart from traditional fiat currencies. Unlike government-issued money, which can be printed in unlimited amounts, there will only ever be a maximum of 21 million bitcoins in existence. This hard-coded limit is a fundamental part of its design, and it's why Bitcoin is so often referred to as digital gold. Like physical gold, its finite supply makes it a powerful hedge against inflation and a potential store of value. The scarcity is not a bug, it is the central feature that makes it a viable alternative to existing financial systems. To manage the release of this finite supply, Satoshi Nakamoto also designed a programmed event called the halving. This event, which occurs approximately every 4 years, or, more precisely, after every 210,000 blocks have been mined, cuts the block reward that miners receive for solving a block in half. The first halving took place in 2012, reducing the reward from 50 to 25 bitcoins. The next halved it to 12.5 in 2016, and the most recent halving in May 2020 further reduced the reward to 6.25 bitcoins. This mechanism ensures that the rate at which new bitcoins are created slows down over time, constantly reinforcing its scarcity and disinflationary nature. The economic implications of this are profound. The halving is a supply shock built directly into the protocol, a predictable reduction in the rate of new coins entering the market. Historically, these events have been pivotal moments in Bitcoin's price cycles. This slow, predictable, and decreasing rate of new supply is a key reason why many believe Bitcoin is a superior form of money for the digital age. You don't have to trust a government or a central bank to manage its supply, you only have to trust the transparent and verifiable code. The cycle of halvings will continue until the last fractions of a Bitcoin are mined, which is projected to happen around the year 2140. At that point, the total supply will have reached its absolute cap of 21 million. From then on, miners will be incentivized solely by transaction fees, ensuring the network continues to be secure for generations to come. This transition is a core part of the economic model, shifting the network's security funding from block rewards to transaction volume. Chapter 3: The Programmable Money, Ethereum and Smart Contracts. More than just money, the evolution to a global computer. While Bitcoin introduced the world to the revolutionary idea of decentralized digital money, it was primarily designed for one purpose: to be a secure, scarce, and censor-resistant store of value. It was digital gold. The next logical step in this evolution came with the creation of Ethereum. Launched in 2015 by a team of co-founders led by Vitalik Buterin, Ethereum took the foundational principles of Bitcoin's blockchain and added a new, powerful capability: programmability. If Bitcoin is a secure digital vault for money, Ethereum is a global, decentralized computer that anyone can use. It's a platform, not just a currency. Its native cryptocurrency, Ether, ETH, is often described as digital gas. It's the fuel that powers all the operations on the Ethereum network. You need Ether to pay for the computing power required to run programs or execute transactions on the blockchain. This innovation completely changed the game, transforming the blockchain from a simple ledger for transactions into a robust platform for building entire decentralized applications, dApps. This concept of programmable money means that the rules of how money is used can be written directly into the code. Instead of simply sending value from point A to point B, you can now embed conditions, logic, and automated instructions into every transaction. This unleashes an incredible new universe of possibilities. In plain English, think of Bitcoin as a digital calculator, great for one thing, transferring value. Ethereum, on the other hand, is like a smartphone. It can do everything the calculator can do, but it also lets you run millions of different apps, from games to complex financial tools. These apps are the decentralized applications, dApps, and Ether is the credit you use to pay for the electricity to run them. The power of smart contracts. The bedrock of Ethereum's programmability is the smart contract. Simply put, a smart contract is an automated, self-executing agreement with the terms of the agreement written directly into the code. It is an agreement that exists on the blockchain and, once deployed, cannot be changed. This eliminates the need for a third-party intermediary, like a lawyer, bank, or notary, to enforce the terms of a deal. When the pre-programmed conditions of the contract are met, the code automatically executes the actions, whether that's releasing funds, transferring ownership of an asset, or triggering another event. Think of it like a vending machine. You put in the correct amount of money, and the machine automatically dispenses the item you selected. There's no need for a cashier, the machine's code handles the entire transaction. A smart contract is the digital version of this, but it can be used for far more complex and valuable agreements. For instance, a smart contract could be used for an insurance policy. If your flight is delayed by more than a predefined time, a condition that can be verified by a data feed from the internet, the smart contract could automatically and instantly release a refund directly to your crypto wallet, without you ever having to file a claim. Smart contracts are also the building blocks for all dApps, which are applications that run on a decentralized network rather than being controlled by a single company. In plain English, imagine a self-enforcing contract without a lawyer. If two people agree to a deal, the terms are locked into a smart contract on the blockchain. For example, you want to buy a house. You put the money in a smart contract. When the seller provides the deed, the contract automatically releases the money to them. If they don't, the money is returned to you. The contract is the middleman, and it can't be bribed or make a mistake. The rise of DeFi, rebuilding finance from the ground up. The most impactful application of smart contracts to date has been the creation of decentralized finance, DeFi. As the name suggests, DeFi is an umbrella term for a suite of financial products and services that operate entirely on the blockchain without the need for traditional banks, brokers, or exchanges. DeFi aims to recreate and improve upon the entire traditional financial system, from lending and borrowing to trading and insurance, in a permissionless, transparent, and open-source way. The core idea is to replace trusted intermediaries with transparent, audited smart contracts. For example, a traditional loan requires a bank to act as the middleman, taking deposits and lending them out. In DeFi, you can use a lending protocol, a dApp, where a smart contract holds the funds and automatically matches lenders with borrowers. Lenders earn interest, and borrowers can get a loan instantly by putting up their crypto as collateral. Similarly, decentralized exchanges, or DEXs, allow users to trade cryptocurrencies directly with each other through automated smart contracts, without the need for a centralized exchange that holds their funds. This eliminates the risk of a single point of failure and gives users more control over their assets. This new ecosystem, built on the backbone of Ethereum and smart contracts, is a direct challenge to the old financial order. It promises to make financial services more accessible, efficient, and transparent for anyone with an internet connection, regardless of their location or social status. In plain English, DeFi is like an automated, digital bank that anyone can access, no matter where they are. Instead of a bank with a CEO and tellers, the bank is a set of smart contracts. You can lend your money to the bank and earn interest, or you can borrow money from it instantly by using your crypto as collateral. Because it's all run by code, it's open for anyone to use and is completely transparent. In this chapter, we've explored how Ethereum evolved the blockchain from a simple ledger to a versatile, programmable platform. We've seen how smart contracts enable automated, trustless agreements and how they form the foundation for a new, decentralized financial system. In the next chapter, we'll dive into the world of alternative cryptocurrencies and the wide-ranging applications they enable, from supply chain management to digital art. Chapter 4: Altcoins and the Ecosystem. Beyond Bitcoin and Ethereum, the world of altcoins. While Bitcoin and Ethereum serve as the foundational pillars of the crypto world, they represent only a fraction of the vast and ever-expanding universe of digital assets. The term altcoin is a broad label used to describe any cryptocurrency that isn't Bitcoin. Standing for alternative coin, altcoins began as simple variations of Bitcoin's code but have since evolved into thousands of unique projects, each with its own technology, purpose, and community. This chapter will introduce you to this diverse ecosystem and help you understand the different categories of cryptocurrencies you'll encounter. The ecosystem is a testament to the open-source nature of blockchain technology. Developers around the world can take the public code of an existing blockchain, modify it, and launch a new project with new features and use cases. This has led to an explosion of innovation, with altcoins addressing everything from privacy concerns to supply chain logistics and even the creation of digital art. Categorizing altcoins, a guide to the crypto landscape. To navigate this expanding universe, it's helpful to categorize altcoins by their primary function or design. 1. Privacy coins. In the early days, many people believed Bitcoin was completely anonymous. In reality, it's pseudonymous, meaning transactions are linked to wallet addresses, but not directly to a person's real-world identity. While this provides a degree of privacy, with enough effort, it's possible to trace transactions. Privacy coins were created to solve this. Monero, XMR. This is one of the most well-known privacy coins. It uses a technology called ring confidential transactions, ring CT, to obscure the sender, receiver, and amount of a transaction. Imagine mixing your transaction with a group of other transactions, making it virtually impossible to tell which one is yours. Zcash, Zcash offers a different approach, giving users a choice between transparent and shielded transactions. The shielded transactions use a sophisticated cryptographic method called ZKSNRKS to prove that a transaction is valid without revealing any of the details, such as the sender, recipient, or value. In plain English, privacy coins are like using a burner phone for a conversation. They are designed to completely hide the details of a transaction, making it impossible for anyone to see who sent money to whom or how much was sent. 2. Utility tokens. As the name suggests, a utility token is a cryptocurrency designed to have a specific function within a decentralized network or application. It's not meant to be money in the traditional sense, but rather a digital key or a form of access. A great example is the native token of a decentralized cloud storage network. Users who want to store their data might need to use the network's utility token to pay for that storage space. Similarly, a decentralized social media platform might require you to hold a specific token to be able to post content or vote on new features. In plain English, a utility token is like an arcade token. You can't use it to buy groceries, but you can use it to play games in that specific arcade. It's a special purpose credit that only works within a particular decentralized app or ecosystem. 3. Stable coins. Stable coins are perhaps the most important bridge between the volatile world of crypto and the traditional financial system. Their purpose is simple: to maintain a stable value, typically pegged 1:1 with a fiat currency like the US dollar. This makes them invaluable for traders who want to lock in profits without leaving the crypto ecosystem, as well as for payments and remittances. Centralized stablecoins, coins like Tether, USDT, and USD Coin, USDC, are backed by reserves of cash and cash equivalents held by a central company. This company is responsible for minting new coins and redeeming them, and their value is backed by the promise of those reserves. Decentralized stablecoins. A stablecoin like DAI is an example of a decentralized stablecoin. It's not backed by a company's reserves but instead maintains its peg to the dollar through a system of smart contracts that are over-collateralized with other cryptocurrencies. In plain English, stablecoins are a digital version of the US dollar that lives on the blockchain. They are used to avoid the wild price swings of assets like Bitcoin. If you want to temporarily take a break from the crypto market's volatility, you can swap your Bitcoin for a stablecoin and know that its value will stay the same. The role of the white paper, the project's blueprint. In the crypto world, a project's white paper is its most important document. It's a detailed, technical report that lays out the project's vision, problem statement, proposed solution, technology, and economic model. Before you engage with any new cryptocurrency, understanding its white paper is crucial. It's a way to verify the team's claims, understand the token's purpose, and evaluate whether the project is viable. When analyzing a white paper, here are some key sections to look for. Problem. What real-world problem is the project trying to solve? Is it a genuine problem or a solution looking for a problem? Proposed solution. How does the project's technology and tokens solve this problem? Tokenomics. This section details the token's supply, distribution, and how it will be used within the ecosystem. It answers questions like, what is the total supply, and how is the token's value maintained? Team and roadmap. Who is behind the project, and what are their qualifications? What are the key milestones and timelines for the project's development? By learning to read and analyze a white paper, you are empowering yourself with the tools to distinguish between a legitimate, innovative project and one that is unlikely to succeed. In this chapter, we've gone beyond the basics to explore the vast and varied world of altcoins, from privacy-focused currencies to utility-driven tokens and stable, dollar-pegged assets. We also learned how to use a project's white paper as a compass for navigating this complex landscape. In the next chapter, we'll dive deeper into the revolutionary world of non-fungible tokens, NFTs, and the new frontier of digital ownership. Chapter 5, A New Kind of Ownership, NFTs and Web3. What is an NFT? A foundation of digital ownership. In the previous chapters, we've focused on fungible assets like Bitcoin and Ether. The term fungible means that each unit is interchangeable and has the same value. For example, one US dollar bill is completely interchangeable with any other US dollar bill. The same is true for a Bitcoin. One Bitcoin is the same as any other Bitcoin. A non-fungible token, NFT, is the exact opposite. It's a unique, non-interchangeable unit of data stored on a blockchain. This uniqueness is what makes it so powerful. Think of an NFT as a one-of-a-kind digital certificate of authenticity and ownership. While the digital asset itself, whether it's an image, a video, or a piece of music, can be copied and shared endlessly, the NFT tied to it cannot. The NFT is the cryptographic proof that a specific person is the sole owner of the original asset. It proves that you, and only you, have a claim to the original creation, much like owning a signed painting or a rare trading card. The blockchain's public ledger guarantees this ownership and provides a transparent history of every owner the NFT has ever had. In plain English, imagine the Mona Lisa. There are millions of prints and digital copies, but only one original hangs in the Louvre. An NFT is like the museum's official certificate proving that you own the original. You don't own the painting itself, which anyone can view online, you own the provable, verifiable title to it. Beyond digital art, the expanding applications of NFTs. While NFTs first captured mainstream attention through the explosive market for digital art, their potential extends far beyond simple JPGs. The core technology of an NFT is the ability to tokenize unique assets, and this has applications across a variety of industries. Gaming. In traditional video games, players might own an item like a rare sword or a unique skin, but that ownership is tied to the game's central server. If the game shuts down, the item is gone. With NFTs, these in-game assets are minted on a blockchain. This means players have true ownership. They can buy, sell, or trade these items on a public marketplace, even outside of the game's ecosystem. This gives players real, verifiable value for the time and money they invest in a game. Real estate, NFTs are being explored as a way to tokenize physical assets like real estate. By representing a property's deed as a unique NFT, a smart contract could be used to facilitate a transparent and instant transfer of ownership, bypassing lengthy and costly legal processes. The token could also be fractionalized, meaning multiple people could own a small piece of a property, opening up new investment opportunities. Digital identity and tickets, NFTs can also be used as a form of digital identity or verifiable credential. A music festival could issue tickets as NFTs, preventing counterfeiting and providing a permanent record of attendance. Similarly, an organization could issue an NFT as a membership pass, giving holders access to exclusive content or communities. This turns simple digital passes into verifiable, tradable assets. The Web3 vision, a decentralized internet. To understand the full impact of NFTs, we need to place them in the context of a new vision for the Internet, Web3. Web 1, read-only. The Internet of the 1990s was largely static and read-only. We could browse websites but couldn't interact with them in a meaningful way. Web 2, read-write. The Internet we use today is interactive. We can create content on social media, upload videos, and build online communities. However, this interaction is controlled by large, centralized companies like Google, Facebook, and Amazon. These companies own our data and control the platforms. Web 3, read-write. Own. Web 3 is the vision of a decentralized internet. It is an internet built on a foundation of open, trustless, and permissionless protocols. In this new world, users own their data and their digital assets. Instead of trusting a company with your identity or your files, you use decentralized applications that store your data on a blockchain. Cryptocurrencies and NFTs are the fundamental building blocks of Web 3. Cryptocurrencies, like Bitcoin and Ether, serve as the native payment rail, enabling value to be transferred directly between users without an intermediary. NFTs, on the other hand, represent a new kind of ownership for the unique items in this digital world. Together, they create a new ecosystem where value and data are not controlled by corporations but by the community of users. This is a powerful shift from a centralized internet of platforms to a user-owned, decentralized internet of protocols. In this chapter, we've explored the revolutionary concept of NFTs as a new form of digital ownership and discovered their potential beyond just art. We also delved into the grand vision of Web 3, a decentralized internet where crypto assets like NFTs empower users with true ownership. In our next chapter, we will examine the risks and regulations in the crypto space, equipping you with the knowledge to navigate this new financial frontier safely. Chapter 6: Getting Started, From Fiat to Crypto. After understanding the theoretical foundations of cryptocurrency, the next natural step is to learn how to move from traditional money, often called fiat, into the world of digital assets. This chapter will walk you through the practical steps of buying your first crypto, choosing a platform to do so, and, most importantly, safely storing your new digital assets. Choosing an exchange, a bridge to the crypto world. A cryptocurrency exchange is a platform where you can buy, sell, or trade digital currencies. Think of it as a stock market for crypto, where you can swap your dollars or euros for Bitcoin, Ether, and thousands of other assets. There are two primary types of exchanges, each with its own set of advantages and trade-offs. Centralized exchanges, CXs. These are the most popular and user-friendly option, especially for beginners. CXs are operated by a single company that acts as a trusted intermediary, similar to a traditional bank or brokerage. They are known for their ease of use, robust customer support, and familiar interfaces. When you use a CEX, you deposit your funds and the exchange holds your cryptocurrency for you, managing your private keys on your behalf. While this simplifies the experience, it comes with a crucial trade-off: you are trusting the exchange with the security of your assets. Well-known examples include Coinbase and Binance. Decentralized exchanges, DEXs. These exchanges are built on the blockchain and operate without a central authority. They allow users to trade cryptocurrencies directly with each other through automated smart contracts. The main advantage of a DEX is that you retain full control of your private keys and your funds at all times. There is no intermediary to trust, which aligns with the core philosophy of decentralization. However, DEXs are generally more complex to use, offer less customer support, and can have higher transaction fees. Examples include Uniswap and PancakeSwap. In plain English, a centralized exchange is like a bank. It's easy and has great service, but the bank holds your money. A decentralized exchange is like a peer-to-peer digital market. You hold your own money, but it requires more work on your part. For your first purchase, a CEX is often the simplest and safest starting point. The first purchase, a step-by-step guide. Once you've chosen a centralized exchange, buying your first cryptocurrency is a straightforward process. Here's a general walkthrough. Account creation and verification. Go to your chosen exchange's website or app and sign up. Because CEXs are regulated, you will be required to go through a process called KYC, Know Your Customer. This involves providing personal information and a government-issued ID to verify your identity. This is a standard security measure to prevent fraud and money laundering. Link your payment method. Connect a bank account, debit card, or credit card to your exchange account. Bank transfers usually have lower fees but can take a few days, while card payments are instant but often come with a higher fee. Choose your crypto, browse the available cryptocurrencies and decide which one you'd like to purchase. For many, a good first step is to buy a major coin like Bitcoin, BTC, or Ethereum, ETH. Make the purchase, navigate to the trading section and enter the amount you want to buy. You'll have two main options. A market order buys the crypto at the best available price right now. A limit order lets you set a specific price you want to buy at, and the order will only execute if the crypto's price drops to that level. Confirm the transaction, review the details, including any fees, and confirm your purchase. The cryptocurrency will now appear in your exchange wallet. Congratulations, you are now a cryptocurrency owner. Storing your crypto, the importance of wallets. You may have heard the phrase, not your keys, not your coins. This is one of the most important rules in cryptocurrency and refers to the fact that whoever controls the private keys to a wallet controls the crypto inside. When you leave your crypto on a centralized exchange, the exchange holds your private keys for you. While convenient, this exposes your assets to the risk of an exchange hack or insolvency. For this reason, many experienced users move their assets off exchanges and into their own wallets. There are two main types of wallets for self-custody. Hot wallets. These are crypto wallets that are connected to the internet. They can be software on your phone, a web browser extension, or an app on your computer. Hot wallets are convenient for making quick transactions or for holding small amounts of crypto. However, because they are online, they are more susceptible to hacking and malware. MetaMask is a popular example of a hot wallet used to interact with the Ethereum ecosystem. Cold wallets, also known as hardware wallets, these are physical devices that store your private keys completely offline. They look like a small USB drive and are considered the most secure way to store cryptocurrency. When you need to make a transaction, you plug the device into your computer and approve the transaction with a physical button. This ensures your private keys never touch the internet, making them virtually impossible to steal remotely. Examples include Ledger and Trezor. In plain English, think of a hot wallet as the cash in your physical wallet. It's easy to access for everyday spending but not a good place to keep your life savings. A cold wallet is like a safety deposit box at a bank. It's a little less convenient to access, but it's the safest place to store your most valuable assets. In this chapter, you've learned the practical steps of entering the crypto world, from choosing your first exchange to understanding the critical importance of self-custody. Now that you know how to participate, it's crucial to understand the risks involved. In the next chapter, we will examine the regulations, scams, and volatility you'll need to navigate as you continue your crypto journey. Chapter 7: Navigating the Risks and Rewards. As you begin your journey into the world of digital assets, it's crucial to understand that it's not all about technological innovation and financial rewards. The crypto space, like any new frontier, comes with its own unique set of risks. This chapter will equip you with the knowledge to navigate the extreme volatility, protect yourself from common security threats, and understand the evolving regulatory landscape. Understanding volatility, the price of innovation. If you've ever looked at a crypto price chart, you've seen a roller coaster of dramatic highs and lows. This intense price fluctuation is known as volatility, and it is one of the most defining characteristics of the crypto market. Unlike traditional stocks that are backed by a company's revenue and assets, the value of cryptocurrencies is often driven by market sentiment, news, speculation, and adoption rates. As a relatively new and small market, a single large event can have an outsized impact on prices. To navigate this, it's important to prepare for the psychological aspects of investing. One of the most common pieces of advice in the space is to only invest what you are willing to lose. This mindset helps to mitigate the emotional stress that comes with market swings. You should also resist the urge to constantly check prices, as short-term noise can lead to irrational decisions. A common strategy to manage volatility is dollar-cost averaging, DCA, which involves investing a fixed amount of money at regular intervals. This strategy helps to average out your purchase price over time, reducing the risk of buying everything at a market peak. In plain English, imagine the crypto market is like the early days of the internet. The promise is huge, but it's a wild ride. The value of a crypto isn't always based on a company's profits, it's often based on how excited people are about it. To handle this, don't invest money you need to pay rent, and consider buying a little bit at a time instead of all at once. Security best practices: protecting your assets. The decentralized nature of crypto places the responsibility for security squarely on your shoulders. While this offers incredible freedom, it also means there's no central bank to call if your funds are stolen. Protecting your assets requires vigilance and adherence to some core best practices. The golden rule, the phrase, "not your keys, not your coins," is more than a slogan, it's a fundamental security principle. Leaving significant amounts of crypto on an exchange means you are trusting that exchange to keep your private keys safe. For long-term holdings, it is always recommended to use a cold wallet, a hardware wallet that keeps your keys offline, which is the most secure option available. Protect your seed phrase. Your seed phrase is the master key to your entire wallet. If someone gets a hold of it, they have full control of your funds. You should never, ever type your seed phrase into a computer or phone, take a picture of it, or store it in an easily accessible digital format. The best practice is to write it down on a piece of paper and store it in a secure, physical location, like a safe. Be aware of scams. Scams are rampant in the crypto world. Be extremely skeptical of any unsolicited messages, fake giveaways, or projects that promise guaranteed, unrealistic returns. Never click on suspicious links, and always double-check the URL of any website you visit, especially when connecting a wallet. Enable two-factor authentication. 2FA. Always enable 2FA on your exchange accounts and any other services you use. This adds an extra layer of security, making it much more difficult for hackers to access your accounts even if they have your password. The regulatory landscape: navigating an uncertain future. One of the biggest factors influencing the crypto market is its uncertain regulatory future. Governments and central banks around the world are still trying to figure out how to respond to this new technology. The responses range from outright hostility to cautious acceptance and even exploration. Restrictive policies: some countries have taken a hardline stance, outright banning crypto trading or mining. They often cite concerns about financial stability, consumer protection, and its potential use in illicit activities. These policies can create significant market downturns and uncertainty for investors. Embracing innovation, on the other hand, many countries are exploring how to regulate the space to foster innovation while protecting investors. We are seeing the rise of central bank digital currencies, CBDCs, which are digital forms of a country's fiat currency. While not cryptocurrencies in the decentralized sense, they show that central banks are acknowledging the shift to a digital-first financial world. The future, the regulatory landscape is constantly changing. As the industry matures, we can expect clearer rules to emerge. This will likely bring more institutional investors into the market but could also alter some of the core, permissionless principles of crypto. Staying informed on a global level is key to understanding how these changes may affect your investments. In this chapter, you've learned to face the realities of the crypto market head-on, from managing volatility to safeguarding your assets and understanding the broader regulatory context. In our final chapter, we will look to the future, exploring how blockchain is set to disrupt not just finance, but the very nature of how we interact with technology and each other. Chapter 8: Case Studies of Disruption. Thus far, we've explored the fundamental concepts of cryptocurrencies, from the pioneering design of Bitcoin to the programmable nature of Ethereum and the unique properties of NFTs. Now, it's time to move beyond the theory and look at how this technology is being applied in the real world. This chapter will provide concrete examples of how blockchain is starting to revolutionize industries, demonstrating its power far beyond just digital gold and speculative trading. Remittance and global payments, a faster, cheaper way to send money. Sending money across borders has historically been a slow and expensive process. Traditional systems, like wire transfers and international money services, rely on a network of banks and intermediaries, each of which takes a cut and adds to the time it takes for the money to arrive. This can be especially difficult for people in developing countries who rely on remittances, money sent home from workers abroad, to support their families. Cryptocurrencies are fundamentally changing this. By using a stable coin, for example, a person can convert their local currency into a digital dollar, send it to anyone in the world instantly and for a fraction of the cost, and then have the recipient convert it back into their local currency. The entire process takes minutes, not days. This is a powerful demonstration of a permissionless payment rail, where value can be transferred directly between two people without needing permission from a bank or government. It provides a more efficient and accessible financial service to the billions of people who are unbanked or underbanked. In plain English, imagine sending an email with money attached instead of a physical letter that has to go through multiple post offices and different countries. The email arrives instantly, and the person who receives it can print out the money right away. That's essentially what crypto does for global payments. Supply chain management, transparency from farm to table. For many years, it has been difficult for consumers to verify the authenticity, origin, or ethical sourcing of the products they buy. A product might be labeled organic or ethically sourced, but there is often no way for a customer to verify this claim. The supply chain is complex, involving multiple companies and intermediaries, and the data is often siloed and difficult to access. The blockchain's immutable and transparent ledger is the perfect solution for this. By using a blockchain-based system, a company can create a digital record for every step of a product's journey. For example, a single avocado could have a digital identity on the blockchain. From the moment it's picked on the farm to its packaging, transportation, and arrival at the grocery store, every step is logged and time-stamped. This data is verifiable by anyone, including the end consumer, who can use a smartphone to scan a QR code on the product to see its entire history. This creates a transparent, end-to-end audit trail that builds trust and accountability for both the company and the consumer. In plain English, it's like a digital birth certificate and travel history for every single product. You can scan a code on your coffee and instantly see the farm it came from, the date it was roasted, and every stop it made on its way to you. Decentralizing the Internet, the foundations of a new digital world. Building on the concept of Web3 from Chapter 5, many projects are now using blockchain technology to build decentralized alternatives to the centralized platforms we use every day. The goal is to give users control over their data, content, and digital identities. Decentralized social media. In the traditional social media model, a single company owns the platform and all of your data, and they have the power to censor or deplatform you. Decentralized social media projects are built on a blockchain, where a user's profile and content are owned by the user, not the company. This makes it impossible for a single entity to remove your account or censor your content. Decentralized cloud storage. Instead of relying on a single company like Amazon or Google to store your files, decentralized storage networks use a global peer-to-peer network of computers. Your files are encrypted, broken into small pieces, and distributed across thousands of computers. This makes the data more secure, more resilient to censorship, and often more cost-effective. These examples show that blockchain is not just a niche financial tool. It is a foundational technology that can be used to build a more transparent, equitable, and user-owned internet. In this chapter, we've seen how blockchain is moving from theory to practice, with compelling case studies in finance, logistics, and the internet itself. In our final chapter, we will wrap up our journey by looking ahead to what the future of this technology might hold. Conclusion: the road ahead. Throughout this book, we've journeyed from the origins of Bitcoin, a revolutionary form of digital gold, to the programmable world of Ethereum and the expansive universe of altcoins and NFTs. We've seen how these technologies are not just abstract concepts but powerful tools already beginning to disrupt traditional finance, logistics, and the very structure of the internet. As we wrap up this journey, it's worth pausing to consider the road ahead and the role you, the reader, can play in this evolving landscape. The future of money. Is cryptocurrency just a passing fad? The answer, based on the foundational principles we've explored, is a resounding no. Cryptocurrency is much more than a get-rich-quick scheme, it's a fundamental shift in how we think about money and trust. The key arguments for its enduring relevance are rooted in its core design. Decentralization, the ability to create systems that are not controlled by a single government or corporation. This removes the risk of censorship and single points of failure. Scarcity, with assets like Bitcoin, a finite supply is built into the code, providing a powerful hedge against inflation and the devaluation of fiat currencies. Programmability, with platforms like Ethereum, money becomes a tool for creating automated, self-executing contracts and entire applications, opening up possibilities far beyond simple payments. Transparency. The public nature of the blockchain ledger provides a level of transparency and accountability that is often absent in traditional financial systems. These aren't fads, they are technological innovations that address deep-seated issues with our existing financial infrastructure. Our journey began with a reflection on the dominance of traditional money. The title of this book, Beyond the Dollar, is not a prediction of the dollar's immediate collapse, but a recognition of a profound paradigm shift. The future we are moving toward is one where a decentralized, digital financial system coexists with, and in many cases, provides superior alternatives to the old one. In this future, we can envision a world where global payments are instant, cheap, and accessible to everyone with an internet connection, breaking down barriers to economic participation. The ownership of physical and digital assets is verifiable and transparent on a public ledger, eliminating the need for costly intermediaries. Financial services like lending and borrowing are open to anyone, run by transparent code, and not controlled by a select few institutions. The internet itself is more democratic, with users owning their data and digital identities, moving away from the centralized platform model of today. This future isn't a single coin ecosystem, it's a diverse, interconnected network of specialized blockchains and digital assets working together to build a more equitable and efficient world. Final thoughts. As we conclude this book, remember that the world of crypto is still in its infancy. It is a space defined by rapid change, incredible innovation, and significant risk. The knowledge you've gained from these pages is a starting point, not an end. The most valuable asset you can have in this new world is not a particular cryptocurrency, but a commitment to continued learning, critical thinking, and responsible engagement. Stay curious, question the narratives you hear, and always prioritize security. The future of this technology is not predetermined, it is being built every day by developers, entrepreneurs, and, most importantly, by the informed choices of its users. I hope this book has provided you with a solid foundation to navigate this exciting and complex frontier. The road ahead is long, but the possibilities are endless.
Thanks for watching. If you want to learn how to make your money work for you, check out my next audiobook, Passive Income Unlocked, Your Guide to Earning Money While You Sleep. We'll cover everything from dividend stocks to digital products. Click the video on screen to start building your passive income streams today.